Before the sun rises, before the city awakens, there's a pulse that beats within Charlotte, a rhythm of ambition, a drive to shape our destiny. At the heart of this city stands UNC Charlotte, a place where dreams are forged and futures are born. From the very beginning, we've been more than just a university. We've opened our doors not just to educate, but to uplift, to stand shoulder to shoulder with our city, pushing beyond the limits of what's possible. For the love of Charlotte, we've never stopped. We've always been driven by an unwavering commitment to our students, to our research, to our community. We've dared to imagine a future bigger than ourselves, and now we stand at the threshold of our boldest journey yet. For the Love of Charlotte is our most ambitious campaign to date, a $500 million endeavor to transform lives, ignite innovation, and enrich our community like never before. This is more than a campaign. It's a movement fueled by passion, purpose, and the unstoppable spirit of UNC Charlotte. For the love of our students who will become the leaders of tomorrow, for the love of learning that will solve the challenges of today, for the love of a campus that is the beating heart of our city, we do this not just because we can, but because we must. Because we are UNC Charlotte, and this is our destiny. Join us. Stand with us. Together, we will make history. For the love of Charlotte.
Well, good morning. Hope everybody's doing well, and hope everybody got a chance to go enjoy the golf tournament this weekend. It was pretty fun. My name is Richard Buttimer. I am the Dean of the Belk College of Business here at UNC Charlotte. Welcome to the North Carolina Economic Forecast. It's always great to connect with business community, our alumni, our students, as well as many of our faculty and staff who are here today. I want to begin by thanking our sponsor, which is the School of Professional Studies, Corporate Training, and Executive Education here at UNC Charlotte. UNC's Charlotte School of Professional Studies, Corporate Training, and Executive Education courses will elevate your organization's performance and foster a culture of continuous learning with their transformative training systems here in the DuBois Center. The DuBois Center at UNC Charlotte is also the home for our Belk College of Business graduate programs. We offer a variety of part-time programs for working professionals and executives, including our nationally ranked Charlotte MBA program featuring both in-person and online options. And in fact, I'd like to point out that in the most recent U.S. News & World Report rankings that were released about 2 weeks ago, our part-time MBA program was ranked number 31 among all public business schools in America. So it's a program that not only is convenient, it is also one of the best programs in the country. Now to our presentation. We'll have a question and answer period with our hybrid audience following today's presentation. So if you're on Zoom, please submit questions via the Zoom chat at any time. It is my pleasure to introduce my colleague, my friend, Dr. John Connaughton, who's professor of economics in the Belk College. For over 40 years, John has been interpreting the data and sharing his expertise on what North Carolina's economy has been and where it's going next. Please join me in welcoming Dr. John Connaughton.
Thanks, Richard. Appreciate it. Good afternoon. I think it's now officially afternoon. So as Richard said, I've been doing this for a while, and I suspect, like most of you, this is the craziest period of time that I've ever had to do this, okay? Things are a little different. So what we're going to do today is we're going to shorten the presentation to 20 minutes to open it up for questions, both for you guys and for the folks that are joining us on Zoom, because I think you're probably going to have a lot of questions. And just a fair warning, I don't have a lot of answers, as you will see as we go through this. So what we're going to talk about today is the 2024 GDP and employment forecast. We're going to talk about the first 120 days of the Trump administration. Then we're going to ask what the Fed's going to do, and then we're going to talk about tariffs, trade war, all the uncertainty that we're all feeling right now. Make sure you don't, if any of you here have business, don't raise your prices. You'll get a text from the president if you do. And the 2025 GDP and employment forecast, which, as I've already mentioned, I have no idea what that's going to turn out to be. So sorry about that. So as you can see here, 2024 was really a good year. 3.7% real GDP increase, solid growth in each and every quarter. If you were here 3 months ago, you probably noticed that at that time we were expecting the fourth quarter to only be about 1.9% because of what went on in Western Carolina as a result of the hurricane. Turns out it had an impact, but there was still enough going on in the rest of the state that we grew by 3.1% in the fourth quarter. So overall, a really, really good year. On the job side of things, not quite as good. These are individual sectors. I'm sorry, I got ahead of myself here. For those of you that are here for the first time or don't remember this chart, the horizontal axis here tells us how much each sector grew, and there are 15 sectors in here. And the vertical axis tells us the percent of total output that each sector contributes to the overall state economy. What that allows us to do when looking really quickly at this chart is looking at the big sectors here, or the big rectangles, and realize that those, because of their size and also their growth rate, the bigger the rectangle, the more it contributed to GDP growth in the state this year. So you can see the big rectangles here are finance, insurance, and real estate, retail, trade. A really interesting one was non-durable goods manufacturing. For the first time in quite a while, turned out to be pretty solid. And while manufacturing is not a big part of our state's economy, as you can see, durables are 5.4%, non-durables are 7.8%, that's a little over 13%. If we had this conversation 40 years ago, manufacturing accounted for 30%, 32% of GDP. So you can see it's really changed in those 40 years. And now the big elephant in the room, if you will, is finance, insurance, and real estate, which is 21% of our economy. Year-end employment trends, GDP growth was really good, but jobs, only 47,000. That's down from about 80,000 in 23. So you can see it took a hit. When you look at it monthly, a lot of that hit was Western North Carolina in October and November and December. And while it didn't affect output that much, it really affected employment as a lot of restaurants, hotels, and stuff closed and had to lay folks off in the western part of the state. It's not a big impact on GDP, but it is a big impact on employment. I'm going to go back once here. You can see that hospitality and leisure services only make up 3.4% of GDP, but they make up 10%, almost 11% of employment. So you can see the shift there in terms of what happens when that sector has a little collapse or contraction. Big impact on employment, not as big impact on GDP. Again, where we're seeing the most job growth was educational and health services and government in terms of employment, okay? All right, so the first 120 days. All right, good news is we're starting to see inflation come down. This blue line is the overall CPI, and the April CPI, when it was released a week ago, showed that year over year, it was now 2.3%, getting ever closer to that target of 2%, okay? The orange line is core CPI, which is the CPI less food and energy, all right? And it's now dropping too. It just kind of got sticky there for quite a while. In the last 2 months, it's come down to 2.8%. We're not there at the 2% target, but we're sure as hell a lot closer than we've been in the last 4 years. All right, so that's the good news, all right? Also good news is U.S. monthly job growth. This, as I mentioned before, was what precipitated, one of the things that precipitated Powell to drop interest rates in September of 2024. People wonder, well, why are you doing that? And part of it was his intent to try to create a soft landing, and therefore he's looking at really a drop in new jobs and decides, boom, I better go ahead and do something. However, as you can see, September's number was off the chart, and it's been pretty solid since then, all the way through April of this year. Very similar picture in North Carolina. This is the hurricane, okay? And this is also what Powell was looking at. We had negative job growth in the summer of 2024, while the country was just off a little bit. All right. Unemployment rates, as you can see, in North Carolina, the orange here is doing real well compared to the U.S. Started last year, started 24 at about 3.5%. Been bumped up a couple of times, but we're still, last number was March, and it was 3.7%. Similar pattern in the U.S., they're now at 4.2%. By any measure, these are full employment numbers. So the employment market is pretty solid and is continuing to remain that way. All right, what we saw that was kind of interesting was we saw the decline in first quarter GDP down by 0.3%. And that caught a lot of people by surprise, and they're like, oh my goodness, what's going on? That's the January, February, March quarter. All right, it was an anomaly, if you will. So what I've got here is the 2024 fourth quarter GDP growth rates by consumption, investment, government, and that's government spending on goods and services, not transfer payments, Social Security, any of those things. Exports and imports. And you can see that consumption grew not as much as it did in 24, but still consumption was up, investment was up, government was down a little bit, exports were up a little bit, but the big one was imports. Okay? Imports are negative, so that means we imported 41% more goods and services on an annualized basis in the first quarter of 2025 than we did in the fourth quarter of 2024. So all of the negative, because it's subtracted, it's C plus I plus G plus X minus M, and all of that is a negative on GDP, and that's what caused the overall decline. But for that, if it had been in the 1.9, 2%, something like that, GDP would have grown by about 1.5% in the first quarter, and nobody would have been concerned. So it was really an anomaly. So what caused that? Anybody want to guess?
Stockpiling before the tariffs.
End of discussion. Okay, that's what it was. Okay, if you go to any import car dealer in this country today, they don't know where to put the cars. They brought so many in the first quarter. All right. The one thing, though, in the first 120 days that is a little bit concerning is what's been going on with consumer sentiment. It's down to 57%. I find it kind of ironic because the car companies said, well, we got to avoid the 25% tariff that takes place on the 2nd of April, so let's bring in a lot of cars and stock up. The problem is, at the same time, consumers are saying, not too sure I'm going to spend on a big ticket item. And so a lot of car companies, domestic and foreign, are sitting on inventories that are 120, 130 days, which usually they want to be in the 70 to 80 day range. Okay, so what's the Fed going to do? First of all, for the last 4 years, we've focused on the Fed and its impact on the economy. What are they going to do with interest rates? They're going to get a handle on inflation. Are they going to have that so-called soft landing that Powell has been talking about? Yada, 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 yada. And all of a sudden, we don't really care what the Fed's doing. Because in just 120 days, tariffs and trade have replaced the Fed as the focus on what's happening with the economy. All right, nobody's worried about what the Fed's going to do. Well, we're going to drop rates a couple of times, maybe in 2025, but it's not a big conversation. Conversation in terms of the economic news is all about tariffs, tariffs, tariffs. So here we go again. Inflation's, I wouldn't say it's under control, but it's certainly in the ballpark. But here's what's going on with the Fed. What are they going to do? We've talked about this before, what the 800-pound gorilla that no one wants to talk about. All right, the Fed has not remitted any earnings to the Treasury. Fed has historically made money. Okay, it's a private organization. It's the Federal Reserve Bank of our district, 5th District in Richmond, with a branch here in Charlotte and Baltimore. They're owned by the banks in this district. They're the shareholders. They do things for banks. They do monetary policy for the country. They make money doing it. However, for the last 2.5 years, they haven't. When they do make money, they remit that profit back to the Treasury. Now they're borrowing money for the Treasury. And right now, the latest tally, which was October of 24, is $204 billion in arrears that they borrowed from the Treasury to keep operating. The principal problem that they're facing is because they've had to keep interest rates so high, even after dropping them 100 basis points in the fall of 24, they're having to pay interest on the deposits that the member banks have at the Fed at 25 basis points above that federal funds rate. So that's putting it at about a little over 4.5% they're having to pay out. But on their asset side, they're sitting there with Treasury bills that they bought to finance the COVID expansion and COVID deficit spending a couple of years ago that are paying 2%. You can see what's happening. They got to pay out 4.5%, they're only making 2% on their assets. You lose money, okay? So that's bothering them as well. So next meeting is in June, all right? Richard and I won't be here, so we have no idea what they're going to do, all right? July, September, and October, how many rate cuts? The current betting is 2. I don't see it in June, but maybe by July we'll see it, okay? And then maybe one more before the end of the year, depending on what's happening. The last time they dropped rates by 100 basis points, and you got to remember, the rate they control is the federal funds rate. And that's strictly the rate that banks charge other banks to borrow money overnight for reserve situations. So when a bank runs a little bit short on liquidity, Wells can borrow from Bank of America overnight, a couple $100 million, and they pay them back the next day, all right? I know it's not the way we work, but it works out fairly well. That's the only rate they control. All the rest of the rates are market driven. And when the Fed dropped in September, started the drop of the federal funds rate by 100 basis points during the fall, market rates, as you can see, the 10-year Treasury went from 372 to 463. It went up by 90 basis points at the same time the Fed funds rate went down by 100 basis points. It's what we call bond vigilantes. The market's saying, no, we don't think this is the right time to drop interest rates and to stop fighting inflation. And therefore, the inflation premium on the 10-year has gone up. In addition to that, same darn thing happened with 30-year mortgages, okay? So that's about September, and that's what it is now. It's gone up about 50 basis points, 60 basis points actually, in terms of the 30-year fixed mortgage rate. So the market is sending a different signal to what money costs than what the Fed is doing. So that's why I think the Fed is going to be real hesitant to do more than 1 or 2 more reductions in the coming year. So lower interest rates, the Fed will increase the likelihood of a soft landing. They'll keep us out of trouble. It'll reduce Fed losses, which in their mind is a good thing. But it increases the inflation risk going forward, especially given that we've got a possibility of tariffs remaining, and who knows how they're going to turn out. But those will be slightly inflationary as well during the second half of this year, potentially. And if they lower the rates, they'll send shock waves into the markets again. If they start doing it before the CPI gets down closer to 2%. However, if they keep rates at the current level, they'll control inflation, but there's a possibility that money will be too expensive and it could cause a recession if the investment part of C plus I plus G comes down. It increases Fed losses going forward, but if they keep rates at the current level, it also provides them with options. Essentially, they got ammo that they can use in the fall if tariffs and the tariff talks fall apart. All right, got 6 minutes to take care of tariffs, trade, and ugh. All right. Anyway, put a picture on this. Since 2000, this is our deficit. And we're now sitting at $917 billion, almost $1 trillion in trade deficit with the rest of the world, okay? Yeah. So here are the countries as of December of 24. This is not the annual numbers, which you'll see in just a minute when we look at individual countries. But China's number 1, and this is down about 100 billion from where it was a couple of years ago. Trump tariffs on China initially had the impact of them moving some production and clandestinely shipping through both Vietnam and Mexico. And as a result, their deficit with us, our deficit with them has come down. But Mexico has gone up significantly, and Vietnam has gone up incredibly in the last 3 or 4 years, okay? So those are our 3 big ones. Then Ireland, and you're sitting there going, what the heck do we buy from Ireland? How much Bailey's Irish cream can we possibly consume, right? And the question is, and the answer is, that's all intellectual property from Apple. So when you look at your iPhone and you say, well, that was $1,000, right? Well, Apple claims that 500 is the little bits and stuff that are inside of it, which are all housed in Ireland. Why? Because they only have to pay a 12% corporate tax, which is less than anywhere else in the world. So it's really that simple. All right, then Germany, Taiwan, and you can see the list right there. But you run out of countries pretty quickly that have any significant debt, a deficit with us. All right, so let's take a look at China. All right, so these are our imports from China. You can see that in 2022, they came down significantly. All right, the gray is the trade deficit, and the blue is imports. Okay, so that's the picture there. You can see that we are upside down with China in terms of the trade deficit, to the tune of about $300 billion. Peak was about $400 billion a couple of years ago. Now let's take a look at Mexico. And here again, unlike China, in terms of the imports, just a steady increase over the last 4 years in terms of the imports coming into this country. Exports also have been doing fairly well, but the trade deficit is rising a little bit, okay? Real quick here, we'll go to Vietnam. They don't buy anything from us, all right? But they sure do export a lot to us. And it's increased dramatically since 2020, as you can see, from 80 billion to 140 billion, all right? And then the European Union, this is a little bit of a problem, but you know, it's been increasing in terms of our trade deficit, but there's a lot of activity going between the US and EU, but it's a fairly small trade deficit when you consider it's, what, 26 countries? 26, 27, I can never keep track. People keep going in and out, you know how it is. And then finally, Japan, take a look at them. Again, a lot of imports, all right? Not that much in exports, but the trade deficit has been fairly stable the last couple of years, but up from 2020. But 2020 may not be a good year to judge because that was a COVID year. Okay, so this is total exports by country. And surprisingly, the US is number 2 in the world in terms of exports. We export $3 trillion of stuff. The problem is we import $4 trillion, okay? But we are a big exporter, second only to China, whose whole economy is built around exporting. They're the last of the mercantilists, or the last of the great mercantilists. Okay, you can look that up on Google and they'll tell you all about what mercantilism is. And then, you know, followed by Germany, United Kingdom, France, and so on. 48% of the world's total exports come from these 10 countries. You know, we used to scream about, you know, the trade, what would you call it, imperialistic trade of the 16th and 17th century with colonies and stuff like that. It's not much different today. They don't have colonies, but you're still looking at only 10 countries out of the 200 and something, and 205, I think, last count, countries in the world, dealing with about half the exports, all right? All right, so takeaways from this. China, Mexico, Vietnam, Japan, and the EU represent 80% of our trade deficit in this country. Deal with those 5, trade deficit basically, I don't say disappears, but gets a little bit better for sure. And this is another interesting thing. In April 25, just that month, we collected $16 billion in tariffs compared to $7.1 billion a year ago. Now, if you do the math, you start to quickly say, well, if we keep these tariffs in place that we had in April, well, maybe we collect a couple of $100 billion in tariffs versus maybe a little less than $100 billion. Not enough to get rid of the $2 trillion federal budget deficit, but it helps a little bit, okay? The UK deal with the US put 10% reciprocal tariffs with some carve-outs. So for example, UK cars can come into this country up to 100,000 before they're subject to the 10% tariff. Rolls-Royce engines, jet engines, can come into this country to help Boeing out because they use those engines from time to time on some of their jets. So there are some carve-outs. The China temporary deal, at least until this weekend, was a 10% reciprocal tariff between us and China with a 20% fentanyl penalty. So our goods are hit with 10% tariffs from China. Chinese goods hit 30% here because of the 20% fentanyl penalty. All right, but then the Chinese decided, well, let's stick it to them a little bit, and this weekend they went ahead and did what? Instituted a dumping tariff on US, EU, Japanese, I think Korean plastics of certain type. So it's not over yet. But anyway, to economists, trade deficits are neither good or bad. Only a small percentage of the tariff is passed on to consumers and producers because it's collected on what we call the last sale price, which is far lower than the retail price. So if you talk about a 10% tariff on imported goods, I think that's where Trump would like to be with all countries, is 10%, because he'd like to be able to collect some tariff money to help the budget. Only about 4 or 5% of that would likely be passed on to consumers. It's not a 10% sales tax because it's done on last sale price, which is the last sale in the country before it was exported to the U.S. U.S. manufacturing job losses, which are part of the reason that we're having this discussion about tariffs, is because of technology mainly, but also consumer tastes have changed, and some of it is foreign competition, cheaper labor. I'll give you an example, funny thing. Consumer tastes. In 1950, the U.S., you know that big C, C plus I plus G plus X minus M? The big C, 2/3 of that was in physical goods. Only 1/3 of it was in services. Today, that's been flipped. 2/3 of what we buy is services, only 1/3 are goods. So you can see, you put technology together with the changing consumer tastes, and all of a sudden you realize there are a lot of jobs that get lost, in addition to cheaper labor and foreign competition. All right, so quickly get the outlook. And I told you at the beginning of this thing, this is a wild guess, okay? Because I do not know what tariffs are going to do, and I do know that tariffs are going to impact consumption in this country. They're going to impact exports, they're going to impact imports, and if they have enough of an impact, they're going to also affect domestic business investment, okay? That's for the components that go into GDP. And I don't know how it's going to happen. I don't know what's going to happen. I'm open to anybody got a crystal ball that can help me out here? Because we can change these numbers real quick. The guy, he can handle that. Nope, all right. So we think we're going to basically be off by 1% from where we were last year. So about 2.7% instead of 3.7%. So it's going to be a rocky year at best. It's going to be off. I don't see, and we'll talk about this in a minute, I don't see a real recession coming this year, maybe not until 26 if it happens at all. On a sector by sector basis, again, you're looking down here at finance, insurance, and real estate, business and professional services, educational, health and services, information and retail trade, all doing fairly well. Again, non-durable goods manufacturing has been doing well the last couple of years without tariffs, okay? So we're seeing a resurgence in our non-durable goods manufacturing industries in this state. On the job side of things, we've already started off real well. Remember, we got 3 months of data, so we're pretty sure we know what should happen during the rest of the year. And so instead of 48,000 jobs like last year, we think we're going to see 72,000 net new jobs this year. Most sectors are going to experience an increase, but again, it's educational health services and business and professional services that are leading the way. Finally, I think the unemployment rate is going to rise from where it is now at 3.7% up to maybe 4.2% by the end of this year. We haven't seen an increase in unemployment this year so far. January, February, and March have all been at 3.7%, but I suspect that we're going to start to see a trickle up of that as some of our industries start to scale back because they're hit with tariffs going overseas, but also because of what we see in consumer sentiment, probably cutting off a little bit of domestic demand. The big thing is the labor market during most of 22, 23, 24 has experienced what we call labor hoarding. Companies constantly hiring people just to make sure they have people because the labor markets have been so tight. They're now loosening up, and so I think we're going to see an end to labor hoarding in 2025. Okay, some takeaways, keys to watch. Fed rate cuts, maybe 2 this year, maybe not. The energy price wild card, energy prices have been very good to us right now. Don't you love buying gas for less than $3? Is that great? I'm getting ready to go on a road trip in a couple of weeks. I'm really excited about buying gas for less than $3. All right. U.S. monthly job growth will come out the first Friday of every month. So the main number will come out first Friday. What's that going to be? The 2nd, 3rd, 4th, 5th of June. All right. May inflation will be on June 11th, and that's really going to be a big number given that it's come down recently. You know, if energy prices stay down, because a lot of that gets driven by energy prices. The FOMC, Federal Open Market Committee meeting is June 17th. They'll have the June 11th number. And my guess is if it stays around 2.3%, we're getting ready to see another Fed rate cut. The interesting part of all of this is for the first time in a number of years, we may actually have a federal budget this summer. We've been operating on continuing resolutions for several years now. It got out of the House Budget Committee this weekend, despite most of the members being asleep. That was a joke, folks. Okay. All right. So we might have a fiscal year budget. The big part of that I think is really important is the continuation of the 2017 tax cuts and them not going away, because that would have the biggest part of that is the 20% pass through on small business. That's the one thing that could really throw a wrench in if it doesn't get through. All right. I know a lot of you are probably not familiar with that, but it exempts the first 20% of business, small business revenue on partnerships and individual ownerships from taxation. It's kind of like an exemption, if you will, or deduction. That's to even their playing field up with the corporate rate reduction that we had back in 17. That's a big part of this, and extending that will be important to keeping the economy on track. Second quarter GDP comes out July 30th, and that'll be a real important read. What you may see is an exact flip of what happened in the first quarter in terms of what's going on with exports and imports. So you could see a really big second quarter. Look at the details. Don't get excited about just the overall number. All right, so exogenous shocks matter. We got so many things going on in the world right now that it's hard to figure, all of which could impact the economy. Ukraine, Russia, what's going on with the Middle East, particularly with Iran. All of these things could have an impact going forward in the second or third quarter of this year. I don't know what's going to happen with the trade war and tariffs, but it's not going to be pretty. I can assure you that. And it's going to, when you're doing trade deals with 30 or 40 countries, and the degree of minutia, granularity that you've got to go through in those trade deals, trying to get them done in a hurry is virtually impossible. You don't have enough manpower. At least we don't have enough manpower to go through that in any matter. So I think that this is going to go on for quite some time. I don't think 90 days is enough to get a lot of them done. Fed policy matters. My guess is there a 60% chance of return of inflation if these tariffs don't get ironed out soon. And what I mean by soon is by the third quarter. The wealth effect on the stock market, if the stock market takes a turn down, people feel less rich, they stop consuming as much and they start saving a little bit more. Not a good thing. So let's get the tariff thing set out. All right, so the end of this is 30% return of inflation in the second half of this year or 2026. 60% no big deal on recession, okay? There's also a little 10% chance that everything could just go perfect and we could have a boom. But that's a low 10%, maybe even 5%. But I like to do things in 10, 20% increments. So this is kind of the wild card that's sitting out there, and that's what all of us that are in economic forecasting are trying to deal with, is what's going on with the trade wars and how that's going to affect recession chances in 2025 and going into 2026. Okay, thank you very much. Happy to answer any questions. I think Richard's going to handle the question deal.
Meaning I'll just point to people and say, these are the questions, yes.
Well, no.
You get to answer
I mean, from the...
From Zoom and everything,
Zoom,
yes, of course. Well, thanks, John. Appreciate that. It's very enlightening, and it is a difficult time to do forecasting.
Oh, yeah.
I've had the opportunity to speak to a lot of the senior people in firms around the region, and they are struggling mightily to figure out what's going to happen next. And that uncertainty in and of itself is a bit of a challenge. So we'll start with folks here in the audience, in person. Any questions? Yeah, right. We'll have somebody with a microphone come down so you don't have to yell.
So one of the points you make was like Vietnam increased. So I've heard various things where essentially a way that we reduce the trade deficit with China is we relocate things to Vietnam, or is it we just ship things to Vietnam and then bring it in so it shows up reflective of Vietnam? Is it really as though we're moving like the supply chain into Vietnam and into Mexico, or are we just shipping from China to Mexico and then?
Okay, with Vietnam, it's a combination of both of those things. So some manufacturing by Chinese companies has been moved to Vietnam, but there is also some transshipments that go through. With Mexico, it's predominantly transshipments. There have been a few little movements, but it's mostly been transshipments through Mexico, so it comes in on the USMCA.
But still, China is better, I guess, does it really solve anything if you do it that second part where?
Oh, no, it doesn't solve anything. I mean, we're still running $1 trillion trade deficit. It's just from a different set of countries now than it was 5 years ago. That's really what's going on. Whether it's movement from China to Vietnam or movement from China to India, that's still trade deficit, okay? And, you know, the transshipment part of it is just trying to, you know, pull the wool over our eyes. But
do we end up paying more for that if it just would have came from China to begin with?
That's an interesting question, and quite possibly yes, given the transportation impact, you know, transshipping, unloading and loading one more time, yeah, and making new labels, because you got to make new labels.
Yeah, probably also has the effect of raising China's cost to some degree too. That's probably not 100% pass through to the consumer, but so it probably has the effect of raising the cost to the Chinese companies, but also raising the cost to U.S. consumers.
I got to tell a story here on this. Just I should have an anecdotal thing. I'm looking to buy something, okay, and I'm looking on Fleabay, and the product was about $1,000, and there was some European, and it looked like they were going to be delayed in shipping. I probably wouldn't get it for a month and a half or so. And so I said no. So I saw a Chinese shipper, and he was $1,000 also. But when you look at the fine print, he was charging $2,000 for shipping, which is to cover his tariff costs. So
we have our first cyber question. What are your thoughts on the Ferguson rule as it relates to the U.S. debt, military spending, and impact on U.S. geopolitical power?
I have no idea what the Ferguson rule is.
I was hoping you did, because I don't either, to be perfectly
Anybody
honest.
here want to help us out? Community, classroom? No? Ferguson. Lynn, could you look that up?
So Alan, one of our staff members, says the Ferguson rule suggests that a great power's decline is tied to its debt service obligations exceeding its defense spending. This Ferguson limit, where interest payments surpass military expenditures, marks a tipping point where the nation's centrifugal forces of debt burden begin to erode its geopolitical power. I do not know if this was AI assisted, but yeah.
Y'all get that, because there will be a test on the way out for exit purposes. You know, I think that what we're looking at here is a concern that, as I said, I've never heard of the Ferguson rule before. I am concerned with a $34 trillion debt that could be in 10 years $50+ trillion. And the reason I'm concerned about that has got nothing to do with centrifugal force or anything like that. It's got to do with how much it costs to service that debt. Okay? So if you got $50 trillion of debt and you're paying, let's just say, 4% interest on that, that's costing you $2 trillion a year to service. I don't know what the federal budget will be in 10 years. I know it's a little over $6 trillion now. That's a third of your federal budget, possibly, maybe 25% of your federal budget that you're just paying for the largesse that you did years ago. And that's where the problem comes in terms of the annual deficits. That's why I'm concerned about $2 trillion annual deficits, is principally because of what it does 10 years from now in terms of the debt service.
Yeah, so it winds up, so I'm a financial economist, not a general economist like John, but there's a theory in financial economics that when the federal government runs really large deficits and funds it with debt, that it crowds out private funding. I think
makes it more expensive.
Makes it more expensive, so it crowds it out of the market. And so I think there's a bit of a sense with the Ferguson rule that if it gets large enough, it starts crowding out our ability to spend on defense. And so at that point, you start losing geopolitical power. Certainly something to worry about, but not something we can see or forecast easily. Put it that way.
Part of the Soviet Union's decline?
It probably was. That was a part of the explicit strategy the United States had with SDI, was spin them into the ground. So yeah, it easily could have.
Yeah, I think at that point in time, they were the Soviet Union was looking at 25% of GDP on defense, and that's what caused a crumble, if you will, domestically, and caused the Soviet Union to break up.
Yeah. We'll go to another internal question before we go to another cyber question. Yeah.
On the chart that talked about import-export, where does the sale of services fit?
Okay, that's in there as well. So when you talk about exports and imports, you're talking about goods and services coming and going. And you're right. I mean, it's important to point out that we typically run a service surplus, okay? There are other idiosyncrasies about trade, the current account versus the capital account. And I'm just going to do this real quickly. The current account has got to do with the import and exports of goods and services. And we run a really big trade deficit, $1 trillion. On the capital account, it's investment money moving between countries. And we actually run a surplus on that. Or technically we run a deficit. And that is, more money comes into this country to invest than leaves this country. So more foreigners want to invest in the US than the US wants to invest in foreign markets. And as a result of that, it almost completely offsets the current account trade deficit, okay? Which is why you would expect, if you're running a $1 trillion trade deficit, over time you'd expect the dollar to depreciate. And it doesn't. And it doesn't because China, European Union, all these countries we run trade deficits with don't repatriate those dollars to their local currency. They turn around and invest them back in the US. Whether they buy treasuries, whether they invest in our stock market, they do. I mean, you look around Charlotte and you look at all the foreign direct investment in plants and in offices around here, okay? And you know, that drives to a great extent our economy. What do we got? How many companies do we have that are foreign owned in the Mecklenburg area, the MSA?
The number's in the hundreds.
In the hundreds, yeah. And I don't know exactly what it is, but it's well into the hundreds, like 300 or 400. Okay, so that's just you know, that's why the trade deficit's a problem on one hand, but it's not necessarily a problem when it comes to depreciating a dollar. Our dollar remains strong because we still are viewed as a good investment opportunity.
Yeah, right there.
Yeah.
How much of the U.S. is GDP is based on stuff that we have direct contracts with other countries, their governments with, like for example, defense spending, where countries buy from the U.S. That
I don't know the answers to that question. Okay, in terms of just defense spending, I do know that we are a big exporter of military equipment. Particularly to our allies. So most everybody's trying to buy U.S. airplanes because they're the best in the world. Most everybody wants to buy U.S. missiles because they're the best in the world. But I don't know what that number is. Sorry. I'm sorry. I do know one thing, and I didn't mention it in the presentation, but it's tangential to what you're talking about. We talk about countries' ability to handle these tariffs that Trump has put into place, and who's it going to affect more, us or them? It's not going to affect us that much because when you look at that C plus I plus G plus X minus N, 70% of our GDP is in consumption. When you go to countries like Germany, it's in the low 60s, high 50s, I'm sorry. China is even less than that. China is less than 50% domestic consumption. So their ability to absorb their production is limited compared to our ability to absorb our production that can't get exported. So just as kind of a tangential to that question.
I think you had a question, and then we'll come to you.
So I 100% agree that U.S. should not have a trade deficit with the rest of the world. I also look at the unemployment numbers and try to figure out what are we going to export more of to close that gap if we don't have people to make the goods or farm or mine. So I guess two questions. One is, where are we going to make that up? And two, how long is that going to take?
That's absolutely fantastic question, okay? All right, so I don't know why I'm carrying this thing around. Now I can talk with two hands, okay? So let me answer that question because it's a great question. If you live in Charlotte, you live in Raleigh, you live in Austin, Texas, you live in Washington, D.C., the last 70 years of trade relations with the rest of the world have been beneficial to all of you. We have gotten cheap products. We have had a higher standard of living. Now, on the other hand, if you live in Kenosha, Wisconsin, or Kankakee, Illinois, or one of those flyover states where the one manufacturing plant that was in that town, that little county, has disappeared, the burden has been immense. So we've all gotten a small benefit, but there's been an expense. Now, to answer the second part of your question, okay, and that is, how long is this going to take? My guess is that we are going to replace some of those factories, but a small percentage. What does I say? Since 2000, we have had 70,000 factory closings in the U.S. Manufacturing plants have closed, 70,000. We're not getting those back. What we're hoping is to keep the next 70,000 from closing. Now, I don't know if that's satisfactory, but I think that's really where this is all about. Yeah, we'll get some back. Trump's been trying to get foreign investment, foreign direct investment in this country. And so that's been part of the process of trying to get some of those jobs back. But the big issue is to keep the next 70,000 plants in the next 25 years from closing, and more job losses, which devastate these communities. When you lose the factory that employed 3,000 or 4,000 people, the drugstore closes, the restaurant closes, the auto parts store closes. I mean, it just isn't those 3,000 people that got laid off. It's a much bigger event in those small communities, okay? I hope that answers your question. I think you were next, right?
We have some folks here from the Allen Tate Company, and if I could ask you kind of spin into residential real estate, I know you're very focused on that, but
You talk to Richard.
home ownership affordability, crisis level?
Certainly a problem level. It's a crisis level. If you are a 30-year-old trying to buy your first home, it is a very, very difficult time to do it today for two reasons. One, to supply. There just isn't enough, and that is primarily local problems. That is, we are not producing enough housing. Markets will produce housing. They don't do it typically because of regulatory constraints. We've got to start removing those barriers. And if you look in Charlotte in particular, it's not just Charlotte-Mecklenburg. It's Cabarrus, it's Rowan, it's all the surrounding counties have to start recognizing that these prices are a function of our regulatory environment, and we need to fix that. It's also a problem because we all got used to 3% interest rates, right? And I remember when I bought my first home in 1990-something or other, I got a 7.5% rate, and I thought that was great because I remember in the 80s when it was 18%. So it is the case, however, and this plays into it, you have a lock-in effect, right? If you bought a home in 2000 at a 3% mortgage rate, it's going to take something really important to get you to leave that home and go buy a different home and take a higher mortgage that you're going to have today, a 6% mortgage. So there is less turnover in the housing stock, and so that's also driving it. So that's more of a federal issue than a local issue because it's really the general market rates, and we still haven't really figured out our housing finance system after the 2008 bubble, right? We're still trying to figure out what to do with Fannie and Freddie and all that stuff. So it's a combination of things. I always hate to say crisis, but it's certainly a problem, and it's becoming a bigger and bigger problem. It's not unique to Charlotte. It's in every major metropolitan area in the country. So yeah.
Do we have implications of a permanent renting society? Would that change? Yeah.
We haven't
big concept here.
We haven't seen a big difference or change in that 65, 66% owner occupied versus. Yeah, we haven't seen a big change. That's because, as Richard was mentioning, there's so much inertia that it's just sitting there and people not doing anything. So, while we're not producing enough new single family housing, so much is already there that it doesn't really change those percentages that much.
But what is changing though is if you look at people under 35, they have a much lower home ownership rate than say my cohort would have had, or looking around the room, most people's cohort would have had.
I got Richard beat on the initial mortgage when I bought a house. It was 11.5%. The 7.5% was my second refi.
Yeah, yeah.
Okay, we had one down here, and then we got a gentleman back there.
Here or there?
Yeah, no, go ahead. I'm not good at this.
That's all right. So sticking with residential real estate, specifically mortgage rates, have you changed what you're using to kind of forecast what rates are? They don't seem to be following like the traditional indicators of years ago. How are you forecasting
They are
them now?
still following to a very large degree Treasury rates. But I think one of his first points was that Treasury rates this past year didn't follow the Fed funds rate, right? We had a reduction in Fed funds rate, but Treasury rates went up. Mortgage rates went up almost in parallel with them. So what it tells you is what's really driving mortgage rates is the yield curve more than.
You got a 5% 30-year Treasury, 6.8% 30-year fixed. Yeah, there's a 1.8% risk associated with that is not associated with Treasuries until Moody's. Never mind, that's another issue.
Right, until Friday.
Yeah.
Piggybacking on to what they were saying too, with mortgage rates going up, now it's getting to the point where we're seeing like maybe 40-year stretches of like people could pay it off in those. So I want to see like two questions. How is that going to play a part in the economy as like now we're looking at maybe 40, 50 years, just to pay off a house or just to even get your foot in the store to get the house.
I don't know if the math works on that.
It doesn't.
Okay.
I mean, it does in the sense, I mean, you're right. You probably can find a 40-year mortgage somewhere. So if you say took $100,000 house, okay, $200,000 house, you can't find $100,000 anymore. $200,000 house, and you looked at doing it for a 10-year, 20-year, 30-year, 40-year term, at this, hold the interest rate constant. What you would find is going from 10 to 20 probably reduces that monthly payment by 50%. 20 to 30 probably gets you another 10%. Going beyond 30, it makes trivial differences because at a 30-year mortgage, your first payment is like 90%, 95% interest anyway. So you just can't really reduce it any further. So I don't think you'll see people do that. But what I think you will see is people saving up significantly more money for a down payment before they actually pull the trigger. And I think that's driving a lot of why we're seeing the 35 and younger crowd waiting longer, because they're really trying to build up more of a down payment so they have a lower LTV and they can still fit it in a 30-year mortgage.
The big benefit here is with the 30-year conventionals that are sort of Fannie, Freddie, whatever. Those haven't changed, and so those are going to have the lowest rates. But if you look at the difference between a 15-year and a 30-year, you're going to see the same kind of interest rate increase for a 40-year, or maybe even more. Although, interestingly enough, because it falls on what he's talking about, is car loans are now, 5 years ago, a 7-year car loan was unheard of. You're really pushing the envelope. Now, it's not that unusual. I've actually seen some ads with 72 month financing from auto companies. That's 6 years. And never saw that before. So we're starting to see, you're right in one sense, we're starting to see some increased time. With cars, it's not a bad deal because cars last a lot longer today than they used to. So it's not like you're going to wind up paying a car that's in the junkyard, okay? But in houses would be the same way. But the problem is when you start going out longer than that, the term structure of interest rates, what you pay in addition for the extra 10 years, pretty much negates any benefit you have in payment reduction. We got one right here, Sam.
Hey, bring it back to tariffs again. Sorry. One of my concerns and question if this is valid. It seems that tariffs would increase the import cost or the cost of goods sold for American businesses, potentially impacting their competitiveness given the global supply chain and that $3 trillion of exports that we have. Is that a concern?
Yeah, that's a concern, but in the last time I did this, I had a slide that was directly at that. Yeah, and well, I charge money for it because it's with the Business Journal, so. But here's the deal. So I did my favorite one. It's the $10 Modelo Especial 6-pack, right? Number one selling beer in America, right? Okay, remember I told you that it's not going up to $12.50 because of the 25% tariff that was in effect back then, or proposed back then. And the reason for that is that the tariff is charged on what's called the last sale price. So that's the Mexican importer, Mexican exporter that's got the product from the Modelo brewery. Now, it sells for $10 here, but my guess is it crosses the border around $5 or $6, maybe $5. So that 25% tariff is not on $10, it's on $5. So a 25% tariff on $5 is $1.25. So we're not even talking about $12.50. Worst case, we're talking about $11.25. Comes over here to an importer, right? And then distributors, and then into the supermarket. And all of them maybe take a little piece of that, but depending on the elasticities of supply and demand at each of those three marketplaces, okay, some of it may be passed on to consumers, some of it may be absorbed. And so when I look at Modelo Especial, which is that Ambev? I think that's Ambev. Yeah, you know, they're looking at, geez, we wound up being the number one beer in America by sales. Do we want to raise prices and lose that when Bud Light's still selling for $9.99 a six-pack? So, you know, there are a lot of marketing situations and demand and supply elasticities that go into that.
What about raw materials for?
I don't think water or yeast cost any more.
I mean, for other businesses, lumber and steel.
But it's the same thing, whether it's lumber or anything else, it's the same thing. There are supply and demand elasticities at all of these points. And the tariff only applies to the last sale price in the country it came out of, which is significantly less than it is so, you know.
Okay, John, we've got time for one final question because I'm getting the kill us sign here. So I'm going to take one from cyberspace. Sorry, we can talk after if you have questions. I want to make sure the cyber citizens get a chance to talk too. The debt to GDP ratio is currently 124%. What percent to GDP do you think is the point of default?
Japan is over 200%. So, I mean, I think we got a long way to go before we get to that point. What I'm more concerned about is the size of the deficit and the percent that is of GDP. There's kind of this. We have this unofficial rule that 2% inflation is kind of what we'd like to see as a cap. We got the same kind of rule with deficit to GDP, which is around 3%. Okay, so if we're running a 6, 7, maybe even $800 billion deficit, it's just not going to be a big deal. That's the kind of deficit we can grow out of over time. But now we're not running that. We're running close. We're what, 1.8 now, and looking at 2 trillion. And the CBO forecasts going out are looking at 2.7 in 6 or 7 years, 2.7 trillion. That's way past the 3% rule. If you run a 3% deficit, the deficit's not growing any faster than your economy is growing at 3% in real terms. No big deal. It's the 5-6%. So while we're 124.5% on the debt, we're now at about almost 6% on the deficit, and that's the troubling one right there. Not the size of the debt, but what we're looking at for the next 10 years in terms of the sizes of the deficits. And those are things. There's not a lot we can do about the debt, but there are lots of things we can do about the size of the deficit. And Congress is trying to work on that right now. But because there's an election coming up in about an hour and a half, at least in their minds, they're hesitant to cut programs that you've become accustomed to.
Well, thank you, John. We appreciate your insights. It's been a great...
And in the words of the Happenings or whatever that group was, see you in September?
Absolutely. So again, we'd like to say if you or your firm would like to engage further with the Belk College of Business in our mission to produce the talent, expertise, and impactful research to fuel economic growth in Charlotte, please reach out. Also, if you've not had an opportunity to see it, next door we have our new Entrepreneurship Center, CoLab, which has space for not only big firms, but also co-working space and other activities for entrepreneurs so they can access the full resources of an R1 research university. So if you have interest in CoLab, please let me know. We'll be happy to arrange a tour for you. With that, we'll end for today, and thank you very much for being here.